Now, with the completion of section 1, we begin our section 2, which is mainly focused, or you can say, which is covering the cash flow and ROI. ROI basically means return on investment. That's going to be a next part of a section B. For now, we'll start with cash flow. So if you recall, cash flow statement is one of the important component of the financial statement. It is a part of the financial statement. So let's start to understand a bit what does cash flow means ideally. What is a cash flow statement? As the name suggests, cash flow is statement provides you with the entire scenario of your cash balances, the cash movements. When is the cash coming in? When is the cash going out? At what point of time you have surplus cash? What point of time you have a deficit cash? When do you need to arrange for the cash? When do you have excess cash to invest and earn income on that cash? And so on. I know it sounds a lot detailed, but it's not. Trust me. Once you understand the template and the components of the cash flow statement, it's going to be a really kid's job for you. So let's go ahead. I believe you must have been understood by now what is a cash flow statement. Okay, cash flow statement just provides you with the entire summary of your day-to-day, monthly, month-by-month cash balances. It can also be weekly. It gives you an entire summary of what point of time the cash is going to come in, from what source is it going to come in, for what purpose is it going to go out, for what reason, to whom the cash is going to be paid, and so on. Okay, so what is the need for a positive cash flow or a positive cash position? So first of all, before we understand the need for a positive cash flow or a cash position, understand the meaning of the term cash position or a positive cash flow. At the end of a period, when you're done with computing your cash flow statement, you might either have a positive side or a negative side. Positive comes in when your inflows are more than your outflows, and negative comes in when your outflows are more than your inflows. Now, why is it important for entity to have a positive cash flow statement or a positive cash position? It is because companies, or precisely here speaking for the project managers, they always need to hold a surplus cash to make sure they are prepared for unexpected contingencies coming up, unexpected emergencies coming up, unexpected expenses coming up. In a way, you can say that simple enough. Okay, that's one of the key factors. So, and when they have a greater opportunities, like but if they had a surplus cash to invest in a better machinery, they can yield better results for the project. So to capture the unexpected opportunities, also you need to be cash ready. You need to have a positive cash flow, and to make sure that you are not facing a cash crunch, so that your entire team or entire project is not under pressure to be completed on an early stage to recover the cash from the customers, because most of the time projects are based on deliverables, and when you have to rush up with the deliverables, there is a great chance of a compromise on the quality. So more than the financial aspect, the positive cash flow gives the project manager a peace of mind that yes, project is heading on a right track. They have a surplus cash to encash every opportunity which comes in their way, which they want to utilize. They are prepared for unexpected contingencies. They have a backup for unexpected expenditures arising on the way, and they have an opportunity to invest the excess cash in a better resources, which will help them to deliver the project in a better way. Okay, or you can say to improvise on their project to make the project more efficient and deliver it more quickly, and so on. So this was a small gist on why is it important to have a positive cash flow statement or a positive cash position. Now this this was all with regard to the aspect of a project manager to manage or to maintain a good cash flow position, a positive cash flow position. Also, there's one more important point which is applicable if the project manager is managing multiple projects. Supposingly, if the project manager has multiple projects on hand going on, if one of the projects falls short of cash and it is in dire need of cash to encash a good opportunity to pay off an unnecessary expenditure or so on, if the project manager is aware of its cash positions at any point of time, and he has a surplus of positive cash flow in the remaining projects and the other projects, he can divert the resources from project A to project B, which is demanding cash flow for the time being, and then when project B generates a positive cash flow, repay it back to project A. This he can do only if he has a good control over every project. He knows the cash position, the projected cash flows in the future period in and out for every project, and then he can use this temporary financing arrangement between his projects itself. So this was this was all with regard to why does the project manager need to maintain a positive cash flow or a positive cash position. Now cash flow from generating activities are classified into three categories. Okay, cash flow cash flow generating activities are classified into three categories. Cash flow generating activities are classified into three categories: operating activities, investing activities, and financing activities. So we'll go in depth for each of them. But remember one thing, as a project manager, you are mainly concerned with the operating activities because this is the area of activity on which you will be able to exercise the highest level of control. The investing activity and the financing activity, those decisions are mainly, or you can say decisions with regard to these activities are mostly taken at the corporate level. However, as we go ahead and see the examples, you'll be able to understand that to a certain extent, even as a project manager, you do exercise some control over the investing and financing activities. But the main area which is under your control as a project manager is the operating activities related to your project. So before we go into the depth of this and see an examples, I just want to give you a quick heads up as to what these three activities are classified as. The operating activities are those activities which are performed by the organization on a day-to-day basis. These are the core operations for any entity, and any activities which generate a cash by way of performing the day-to-day operations, those cash flow are reported in the operating activities. Let's say, for example, payment from receipt from a debtor to whom sales was made on credit, cash sales, your payment to creditors, the salary payments, your office rent, utilities payment. All these activities, if you realize, they are the core operations. They exist to support the core operations of the entity, and hence these all are classified as an operating activities. Investing activities, as the name itself suggests, when you have a surplus amount of cash lying with you, you don't just keep them in the bank lockers or in your company lockers. You need to invest them so that even they can generate ideally an income for the company, an income for the organization. So whenever the entity has a surplus cash and it invests in generate an additional revenue from that investment, it is called as investing activities. Now it's not necessary that the surplus cash is generated only for the purpose of income, earning the interest income or the dividend income. No, many times the companies need to purchase a new asset, a new equipment, a new land, a new office building. All those things are done to support the day-to-day operations of the entity, but they do not fall under operating activities because they are not the core operations of the company, right? That's why these all the activities of are classified as an investing activities. One is whenever you have a surplus cash and you invest it in some bonds, securities, deposits, any kind of thing, and any purchase or sale of those securities are termed as investing activities, are reported as a cash flow from investing activities. Also, whenever you purchase any fixed asset, machinery, plant, equipment, also, or when you sell those equipment or those fixed assets, the cash flow generated from them is classified as an investing activities. And lastly, we have the financing activities. Financing activities are those activities where the entity enters into a financing agreement with institutions to raise capital for their company. It can be by way of a loan, by way of issue of new shares, and when they have a surplus cash, they can also buy back their own shares, repay out the loans, and stuff like that. So those are all classified as a financing activities. So I believe by understanding this different area of activities, you must have got an idea that operating activities are the area where you as a project manager have a greatest level of control. When you have some surplus cash, you invest it, but that's going to be a passive income for you. You cannot exercise much control in that area. That's up to the entity's policy also, whether it's allow the project managers to invest the cash or they ask them to return back the cash when they have a surplus and so on. So with this mindset, we'll just go ahead and see an example on the cash flow for, first of all, for an organization as a whole. Then we'll see a small cash flow statement which technically can be said relates to a project manager, how a project manager can prepare his own cash flow for his own project. Okay, we'll see that in the next session where we compare with both the examples simultaneously. Till then, I hope you had a good understanding of the cash flow statement. Make sure to repeat the slide again, at least go through the points again, because this is one of the crucial components for you as a project manager to analyze how do you manage your cash and analyze what point of time you need the cash, when is the excess cash lying around that you can invest in, and so other questions. Now let us understand an example on a cash flow at an organization level. Then we'll look at an example on a cash flow at a project level. We'll continue with the same trend where we prepare the entire thing from scratch in Excel. So even you can have an understanding how things go on, what is the flow of its movement from one point to A, point to B to point C, and so on. Okay. So first let's prepare cash flow at the organizational level. Okay. So let's say in the books of ABC Inc. We'll say statement of cash flow. So we need particulars, we need amount which will be in dollars, and so on. Okay, let me just make this whole thing at a proper level first of all. Okay, 12 seems to be good enough option now. The first thing is cash flow from operating activities. Okay, this will be a first activity. As you defined, cash flow statements is broken down into three components, or cash flow generating activities are classified into three activities: operating, investing, and financing. We'll begin with the operating section first. Okay, what can be the first we'll look at what can be the inflows from a cash flow from operating activities. Okay, so let us say collection from debtors, the most common one. Okay, I just remove the bold. You can say collection from your debtors. Might be, let's say, around $20,000. And also we'll put this statement of cash flow for the month of March 2018. Okay, $20,000 received from the debtors. Then we can say we received a collection from, what else can be the collection? Okay, discount, any cash discount which you received, will they come into this cash flow statement? No, they don't, because you only record the actual cash coming in and actual cash going out. Debtors, discounts, and trade discount, sales discount, all those will be taken care in your income statement, your profit and loss statement. Okay, so what else can be the thing over here? Okay, let's say we have a cash sales. That's, let's say, $10,000 cash sales, right? We have a sale of an obsolete stock. That can be around $1,000. So that was good enough for collection from the debtors and cash inflow coming in from the operating activities. Now we'll look at some of the outflow of the cash. First up, one common, payment to creditors. Cash going out, so it is supposed to be a minus figure over here. Let's say $10,000. Okay, one more important aspect which we need to remember: whenever there is an inflow, you add it to the cash flow. Whenever there is an outflow, you deduct from the cash flow. Okay, keep this thing in mind always. Whenever there is an inflow, you add it. Whenever there is an outflow, that's deduction from the cash flow statement. So here we have payment to creditors. Then let's say we have a selling expenses, that is your salesman commissions, your transportations, and whatnot. Minus $2,000. You paid your salaries to employees for March. That's another $5,000. You paid your utilities for March 2018. That's another $2,000. Oh, sorry, minus $2,000. Okay, so that was good enough, and this total gives up the net cash flow from operating activities for March 2018. Okay, and here you just use the summation formula for the entire amount, and you have a positive cash flow of 12,000 for the month of March from your operating activities only. This is all with regard to operating activities only, right? So in the same line, we'll just see, and remember one thing, that is at the organization level. We are talking about the organization level. The project wise cash flow will be much more condensed, much more shorter in size and transactions and volume, but it's better to know first of all the big picture, then cut out and customize a small picture according to the requirement. Okay, so here now we'll move to see how the cash flow from investing activities work, and for that we'll use the same template from the operating activities, and we'll just modify it as per the requirements. Cash flow from investing activities. Okay, obviously the activities line item are going to change for sure. So let's say what can be chances of an inflow from an investing activities. We had mentioned sale of fixed assets. So sale of an equipment is an investing activity. Cash inflow due to an investing activities. Let's say we sold the equipment for $50,000. We can say we purchased an equipment in place of the old one. Purchase of a new equipment, oops, equipment for say like $60,000. Then we sold investment in shares of XYZ company for let's say around $20,000. Here you have a positive cash flow, and purchase of new equipment is supposed to be a negative cash flow, so it's gonna be a minus figures over here. Okay, so I think yeah, that's pretty much good for the investing activities section. I believe you get the point which we're trying to emphasize, and we'll move on to the financing activities section for the company at the organizational level. Oh, sorry, purchase cash flow from your financing activities. Financing activities. Here, what can be a financing activities? Come on, let's try to think it together. We paid a dividend on outstanding shares, so that's cash outflow due to the in financing activities. Because you have the shares, you are liable for paying dividends, and that's why it's a financing activities outflow. We bought back a shares, buyback of shares, because we had an exist surplus cash, buyback of shares. But let's say even that's an outflow because you have to pay the cash to get the shares, another $5,000. We can say we issued bonds to raise capital for a new machinery, for purchase, for expansion of activities, or any other reason, but just issued bonds for let's say $30,000. But issue of bonds is where company is getting the money in. Okay, they are utilizing the cash, so that's another $30,000, and that's a positive cash flow. Yeah, I think that's good enough to go now, and believe we can put a conclusion to our cash flow statement, ending statement. So with this, we need to be analyzing what is the ending cash balance for the month of March. So before that, we need to know what is the net cash flow. Okay, that's it. Net cash flow for March 2018. That is going to be, let's say, label operating activities labeled as A, net cash flow from investing activities labeled as B, investing activities labeled as B, and lastly, net cash flow from financing activities labeled as C. Oh yeah, the C is going to be hectic, or it will pull up the copyright mark symbol, so just keep it simple, C. So the net cash flow from for March 2018 is going to be your A plus B plus C. That will put the formula over here. That is going to be $12,000 plus $10,000 plus $15,000. That's going to be $37,000. Okay, so this was your net cash flow for the month of March from the various activities, but there's still a catch. We're not completed a cash flow statement. Yes, hold on a while. Now to this, we add the opening cash balance on 1st of March 2018. Now this balance was brought forward from the February 2018 cash flow statement. Okay, understand this thing. When you're figuring out the cash flow, you need to reach the end balance of cash for the particular month, right? And to reach the end balance, you also need to account for the opening balance. How do you calculate what is the end asset you have in hand? You need to figure out the opening balance first, then add the net effect of all the transactions, which can be positive or a negative. In our case, we had a positive cash flow, and that gives you the ending balance of a cash flow. Let's say in the month of March, in the month of February, we had a negative cash balance of $5,000. Okay, so here we put minus $5,000, and so that gives you cash balance on 31st of March 2018 as $37,000 minus $5,000, that is of $32,000, is your net cash balance at the month of March, or you can say precisely closing cash balance on month in March 2018. closing cash balance as on 31st of March 2018, that goes to $32,000. So yeah, that was all how an organization level cash flows statements are prepared. And now with this, I hope you have a good understanding of how the cash flow statement operates, how you need to measure your cash flow, understand how the organization level cash flows are prepared. And now we'll quickly look at one more example, which is going to be a very small cash flow statement, but that will be with regard to a project. I'm not going to be able to list out every single item which is going to be covered in the project. It depends on project to project. For example, IT-based projects will have a different cash flow items, line items, especially with regard to the operation expense. The marketing projects will have marketing project manager will have his own different cash flow line items, especially in the operating section statements, again depending on the activities carried on by them on a recurring basis or the activities which form a core part of their project. But I believe you'll be able to get a small hint how is the project level cash flow going to look like, but it's nothing going to be different compared to what we just looked over here. Okay, we'll take the same example over here, use the same thing and put it over here in a side-by-side basis, so that should help you also to get a quick comparative analysis precisely. Okay, cash flow at the project level. Sorry, caps lock was on. Project level. Okay, we don't need to write this books and all. We'll just label project XYZ and we'll label the project manager as our famous Mr. X. Okay, statement of cash flow for, we just need to modify the labels here, project XYZ for the month of March 2018. Now, what can be the cash flow for project X for Mr. X? It's obviously data collection can be there if it's a revenue driven project where they have the timelines and all set it up. We'll say we had a collection of somewhere around $5,000 for the month of March. Cost of sales, cash sales, nothing. We'll remove this thing. Obsolete stock is supposed to be the company's liability, I think so. We paid to creditors for, let's say, $2,000, which are only relevant to Mr. X project over here. Okay, selling expenses may not be there. We'll keep it for the timing, but we'll reduce the amount. It cannot be that substantially high, so we'll just put it as $100 over here. Salaries to employees. Here we need to put one more thing. A project can have a couple of employees specifically hired for a particular project, or they can have the common resources of the company which are available to all the project managers. We'll put into account only those salaries which are paid to employees who are specifically hired for project XYZ or are specifically involved in project XYZ. Okay, so that's gonna be something around like say $2,000 additionally for the month of March. Utilities, no, they're going to be common throughout the organization, so that gives us a net cash flow of $900 for project XYZ's operating activities. Now, cash flow from investing activities, all these things, sale of equipment, purchase of equipment, selling of shares and all, they all are the organizational activities. They cannot be reported in the companies or the project's cash flow statement. So let's try to understand what can be an investing activity for the project XYZ, or you can say for Mr. X. Supposing even he had last month this $900 from operating activities, and he invested that cash flow in a liquid fund for a period of 1 month to get an interest income on that. So investment in liquid fund, we'll put it investment in liquid fund. He's a smart guy. He won't invest the entire amount. He knows he need to have some amount in his hand to spare. So he just invested $500 of the liquid fund. So now net cash flow from the investing activities is gonna be $500 only, right? And lastly, we have financing activities. If it's not going to be most of the cases that project managers are liable to raise finance for their own projects. No, they get access to the common funds of the company, because companies decide that this is the budget we have for this project and you need to play within this budget only. Here is a check for your project, check of budget which is there for your project, and so on. But let's say over here Mr. X is at liberty to raise the loan if needed. Okay, and this is supposed to be collateral free working capital loan. So we just put over here working capital loan for project XYZ. I think $1,000 should be sufficient based on what the working capital requirement is coming up. And so they raised a working capital loan of $1,000. Now net cash flow from operating activities. Oh, sorry, I'm not supposed to write this here. It's supposed to come over here. $1,000. Now, net cash flow from the operating activities, let's say that is the total. Obviously, that's the total of these three things. Sorry, my bad. I went to a different zone. Okay, so your net cash flow A plus B plus C is going to be $1,400. Negative 900 from the operating activities. Invested 500 out of that. That leaves you with a balance of 400. Additional $1,000 loan for the working capital of the project XYZ. That gives you a total of 1,400 net cash flow for the month of March. Also, additional opening, he had, let's say, suppose an additional funds of $200 in hand on 1st of March. Closing balance of Mr. For the project XYZ on 31st of March comes to $1,600. So technically speaking, there's no difference in these two on a fundamental levels, right? Principles are the same for both of them. The only difference lies in the line item. The one for the organization level is going to be an exclusively detailed one. The one for the project level is going to be relevant only for those items which are incurred for the projects. That's it. So this was all with regard to an example on a cash flow statement. I hope with this you have a thorough idea, a clear-cut idea of how the cash flow statements are prepared, both at the organization level and at your project level also. Fundamentally speaking, there's no difference in the application of the concept. The only difference lies in analyzing the items and allocating them among the operating, investing, or financing activities. But as a project manager, most of the time you need to be worried about your operating activities because that's where you have an exclusive control. The other areas, you can just leave it to the higher management of the company or the finance team of the company. Your core focus should be only in this section, the operating activities and how to maintain a positive cash balance, a positive cash position in this section. That was all, guys, for the cash flow statement. Now we're going to look at another important, or you can say a small type of strategic for you project managers on how you can enhance your cash flow position of a project. Okay, what are the small steps, small improvements which you can undertake as a project manager to make sure you have a good cash flow position, or even better that you are improving your existing cash flow position? The first is increasing the credit period from the vendors. Now, if you are having a bulk procurement, if you're purchasing the goods in a bulk quantity from your vendors, you can negotiate for a good deal of a credit period within them. Suppose if you have an existing credit period of 60 days, you can get it extended to somewhere around 90 days at least. Okay, but it depends on the quantities which you're going to purchase from them. Or if you have a good relation with them where you have been paying your credit on timely basis to them within the due dates, make sure to utilize the entire credit period from them. You might be wondering, how is that enhancing, or you can say, how is utilizing the credit period going to enhance my project value, my cash flow position? It does. Nowadays, at least, there are funds where you can park the additional funds above, just say any funds above 5,000 can be parked in an FD for at least 7 days. Okay, the minimum requirement is 7 days and 5,000 rupees. So let's say you have to pay a vendor an amount of rupees 1 or 2 lakh, and you have been paying it before the credit period gets over, supposedly within 30 days, you're losing the opportunity to earn entire 1 month of interest, and your vendor who's receiving funds from you early is going to park the funds in his own account FDs and get an interest from that funds. So try to get more credit period from the vendors is the first principle. If not more, negotiate for a cash discounts, for a great discount, a good discount rates, and at least make sure to utilize the entire credit period from your vendors rather than paying it upfront to them just for the sake of maintaining a good relation. No, if you have a 60 days credit period, it's better to pay on the 59th day and utilize and keep those funds parked in an liquid investment, or you can say kind of fixed deposit for those 59 days and earn an interest income for your project, which will improve your cash flow position. Next is decreasing the credit period of the debtors. Now here you need to do exactly the opposite of which you are doing for your creditors. Negotiate with the debtors, show them the benefits which your project is giving them, show them the benefit which the goods are going to give to them, and try to negotiate it and negotiate the credit period down to, supposedly if you have an existing credit period of 90 days, try to get it down to 60 days or even better 30 days. That's how you negotiate and get more. The earlier you receive the funds with you, the more you can park them in a liquid investments and earn a passive income from that also. Okay, the idea here is to get the money in your control as soon as possible so you can invest it for your own betterment. Okay, those are the strategies which you need to apply as a cash project manager. Other thing is eliminating the unnecessary expenditures. Obviously, if we take a deep look, if we scrutinize our records, every cash, every penny spent, we realize most of the time, not in just project manager, but also in a personal life, there are a lot of opportunities where we can save the money, where we can save the unnecessary expenditures. And not only that, saving of the unnecessary expenditures, but when we invest those unnecessary expenditures very well, smartly, we earn a good amount of income on that, a passive income. In the personal life, that leads us to a financial independence, financial intelligence. In the project management perspective, it leads you to a better cash flow, a positive cash flow, an enhanced version of your positive cash flow. Next is investing the idle cash to generate a passive income. As the guy said in the book, The Richest Man in Babylon, never let your money sit idle. It should always be working for you 24 by 7. Whatever income you get from your cash flow, you keep on investing that, investing that, investing that. And that compounding of interest gives you multiple fold returns. But that's applicable for a long-term scenario, 10, 15 years down the line as a project manager. But still, it's important that whatever cash savings you are making, any unnecessary expenditures eliminated, any received from the debtors earned at an earlier point of time, any payments made to creditor by and using the entire credit period, you need to generate a cash income on that. And how can that be done? By investing it in the surplus, by investing your surplus cash, right? Lastly, make sure to repay the loans and the interest on the due dates to avoid the penalties and additional interest payments on the late payments. This is applicable when you have taken a loan or for your project, okay? When you have been given a loan for your project and management of that loan is entirely up to you. So in that case, make sure you're paying up the loan, especially on the proper due dates, making the entire interest payments on the due dates, and thereby maintaining not only a good credit position, but you're also avoiding a lot of bad reputation, a lot of additional interest payments and penalties, a lot of cash outflow, which could have been gone out by way of additional interest payments and penalties and so on. So these were some of the few pointers which you can use as a project manager to enhance the cash flow position of your project, to generate a positive cash flow position on your project. I hope with this, you are able to comfortably analyze a cash flow position, study the cash flow position, prepare one for your own, and apply the steps to enhance and come up with more tips on your depending on your projects to enhance your cash flow position for the project. With this, we complete a part B of cash flow. In the next session, we're going to start with the ROI, that is return on investment. Now we're going to come to the other part of section, that is ROI, which is return on investment. So first of all, what is a return on investment? As the terminology itself suggests, you're going to invest a particular amount, you're going to invest some time and resources in a project. What is the return you expect to get from the project? And that return you're going to quantify it in mathematical terms, okay? So it has to be something which is quantifiable. The return which you get has to be something quantifiable. Now, many times projects are undertaken with the intention of non-financial returns also, like brand value enhancement, goodwill creation, and making people aware of your company's product and all those things, which ultimately lead to obviously increase sales, increase revenue, increase profitability. But the intention of a particular project may be to enhance the non-monetary, non-financial factors for a company. But we're going to restrict ourselves only to the financial factors and understand how do companies evaluate the ROI, the return on investment, and take decisions accordingly. So, to summarize, what is an ROI? It is just the return which you expect to get on your investment, which is quantified in a mathematical terms for a financial understanding. Okay. So this was not a standard definition. First of all, by the way, this is something which I have been trying to give you in a layman's language so that you can be aware, especially those with a non-financial backgrounds, you can be aware of meaning of an ROI, return on investment. Okay. So let's understand how do companies use the return on investment to evaluate which project needs to be undertaken. And this can be done better, can be understood better only by the way of an example. So we'll go back to our way. Let's say the company is doing an analysis of which project it should take up, which project should choose. It should choose. Okay. Now over here, let's say the company. Okay, let me first make it at 12. The company has a budget of $1 million. So that is the resource constraint. The maximum the company can spend on the project is $1 million. Now it can choose a combination of two projects or drop one or choose all three if the project requires only that maximum limit of investment. We'll see how it works out in now. Let's say the company is considering three projects: project A, project B, and project C. This will be project C, project B, and project A. Okay, so by taking these projects, the company expects an increase in revenue. This will be in absolute dollar values. By undertaking project A, let's say the company expects to have an increase of $500,000. Okay, 5 million. Sorry, 500,000. By undertaking project B, the company expects to have an increase of 5.5 million. And by undertaking project C, it goes for a $700,000 increase. Five zeros, right? Now this is the expected increase in the revenue. Okay, for that the company obviously needs to incur some cost, additional cost, or you can say additional investment to take the project, to undertake a project. For if the company wants to go for project A, it needs to shell out an investment of $400,000. For company B, let's keep it at somewhere around $420,000. For project C, let's say it's gonna be somewhere around $500,000, so it's gonna be $500,000. That's the additional cost or the investment which the company needs to make. Now notice over here, combining these three projects, the investment is 1.3 lakh. The company does not have a bandwidth to go for that level of investment. You can say the company can go for project C and project A, because here the project C seems to be promising in terms of absolute dollar values. Oh wait, let's just complete this whole table first of all. Net profit from the project in terms of dollar values is going to be simple. Expected increase in the revenue minus the additional cost. So sales minus the cost of the sales, that's going to be your increase in the revenue. Now looking over here, you might be tempted to take up the project C because that has a profitability of $200,000 compared to project B and project A, which are seriously lagging behind project C. In fact, project A has just half the profit of project C. But let's not jump to conclusion first and understand the ROI percent on this thing. Now, how is the return on investment going to be computed? Return on the investment is going to be your net profit divided by your investment amount or the additional cost. Over here, we'll label the net profit as B and additional cost or investment as A, and it's gonna be a mathematical computation now. That is 100,000 divided by $400,000. That's gonna be 25%, I believe so. Yeah, and the same formula applies for this things over here also. So here it's gonna be 31%, and for project C the return on investment is 40%. Now let's try to tweak the numbers a bit to see how the computation changes in terms of dollar value and percentage value. Over here, it's simple enough. Project C is a first preference, project B is a second preference because it gives both a good return on investment and in terms of absolute dollar values also. Now, let's say to undertake project C, the company will have to incur a cost of $550,000. Okay. So, if you see, they're still project C has a profitability greater than project B in terms of dollar value. But the return on investment drops down from 40% to 27% just by an increase of a cost of $50,000, right? That is why the concept of ROI is very important to understand, guys. If you just go by the dollar values, absolute dollar values, you end up choosing a wrong project, which gives you a less profit percentage, less margin, less return on your investment compared to the other opportunities in hand. Let's say over here we do some maths for this thing also, project A, and we decrease the cost just by $20,000. Just by decreasing the cost by $20,000, Even though project A has the least profit in terms of dollar value, still it becomes the number one preference because the return on investment jumps to 32% compared to the B 31% and project C, which is now worst at 27%. So I hope with this you understand the company's perspective of how they're going to select the projects based on the return on investment. They're not concerned with just the profitability figures. That's the next point for them. The first point is what is the project going to be generating in terms of the return on investment. And mark this thing, all the companies have an internal predefined set of a return on their investment. Let's say if your project generates 5% return on investment and the government bonds are generating giving a risk-free return of 7%. In that case, companies won't even consider your project. They'll directly put the funds which they can allocate to your project in the government bond because those are risk-free. It returns risk-free investment which are guaranteed to generate a 7% return compared to your project which is only generating a 5% in terms of financial policies. So that was all with regard to why is the what is the importance of ROI, return on investment. Now we'll mark over your preferred projects in terms of their orders. Project A becomes number 1, project B becomes number 2, and project C becomes number 3. I'm sharing this template with you guys, this whole Excel sheet with you guys, and you can play around with the numbers and go and do a sum of more of your research to get a good understanding on the return of investment concept. Next comes the point is that why is it important for project managers to know the concept of ROI. So till now, whatever project this return on investment competition we've done, we had done it with the point of a company's point of view. How does companies use the projects, use the ROI to evaluate which project to choose? What is the point of understanding the return on investment for a project manager? Now, because as a project manager, you understand how the companies compute the various opportunities, how the companies compute the various projects return on investment, and then choose the project. Before submitting your figures to the company, you yourself can do a certain analysis and certain cost benefit comparison in the same style and figure out what unnecessary cost you can eliminate. Figure out what small increase in the cost, what small reduction in the cost can generate an increase in the revenue, can do a cost saving. As you had seen, when we just reduced the cost by 20,000 for project A, suddenly it became the most preferential project from being number 3 to being on number 1. So that's why it's important for you as a project manager to know what's the importance of those small cost saving also going to have on your project for being chosen in the long term, also for proving as a profitable project. So that was all guys with regard to the return on investment. I hope you get the good point about understanding what is the return on investment and how to do the various computation. Make sure you do have a thorough understanding of this. This is going to be a useful project not only in terms of your professional life but also in terms of personal life. How it can be useful in your personal life is that when you have certain investment opportunities, when you have an idle fund lying around with you and you intend to invest it, you can use the same return on investment concept. For example, a friend of yours who is opening a startup is interested in taking a loan from you, whereas on the other hand, you have a risk-free return from the government for 7%. Now that's how you determine which investment is a better one. Is your friend startup going to be generating that return sufficient in the future? Or is it better to put the funds in the government backed risk free securities that are going to give you a safe and secure return on your investment as well as a principal? Okay, so I hope with this we have a good understanding of cash flow as well as return on investment. In the next session, we're going to see one more important concept, which is going to be capex versus opex, that is capital expenditure versus operating expenditure. Now we're going to cover one important aspect which you as a project manager should always be aware of, that is capital expenditure versus operating expenditure. Before we go in depth of how these two are important for you as a project manager, how you plan for your various expenses based on understanding of the capital expenditure and the operating expenditure, let's look at what is precisely meant by capital expenditure, what is precisely meant by operating expenditure. First, let's understand the term capital expenditure. The capital expenditure is that expenditure which results in purchase of a new fixed asset, procurement of a new fixed asset. Now that can be anything. It can be a new factory, land, building, machinery, anything which involves a huge investment on the part of the company of resources. It can also be any expenditure which is carried out by way of repair, which does either of the three things to that asset which is being repaired. It either makes it bigger, better, or longer. Now by this three analogy, we mean that is it making the asset bigger in size, thereby increasing its production facility, enhancing its features and such stuff, then yes, it is a capital expenditure. Is it making it better? Suppose by incurring this expenditure, let's say of about $100,000, your factory is now going to be able to produce 1,000 units extra per hour based on the previous output. So that is making the asset better in efficiency. So that is a capital expenditure. Is it making the asset longer? That is it extending the useful life of the asset by incurring that expenditure? If yes, then it is a capital expenditure. If the asset does not result in, if the expense, which is kind of a repair, does not result in the asset becoming a bigger, better, or a longer version of its existing version, then it's not a capital expenditure. It is just an operating expenditure. Also, if the expense results in procurement or purchase of a new asset, yes, it is a capital expenditure. So that is a criteria for understanding an expense, whether an expense is a capital expenditure or not. Okay. The other expenditure is the operating expenditure. Now, the expenditure which is incurred to ensure the day-to-day operations are carried out smoothly are known as operating expenditure. To put it in other words, any expenditure which is not a capital expenditure can be termed as an operating expenditure. Now, that can be your purchase of the goods from the creditors on a day-to-day basis, paying of the factory rent, utilities, repairs and maintenance of the existing machinery to ensure smooth functionality, but it does not make the asset any bigger, any better, any longer. It just keeps on the existing machinery, existing asset functions smoothly. That's it. So that is an operating expenditure. So with this, I hope you have an understanding of what is meant by capital expenditure and what is meant by operating expenditure. Capital expenditure involves a huge outflow of cash certain point of times, right? Understand this thing importantly. We look at another important concept based on this understanding: what is buying versus leasing. Now, whenever you buy a new asset, that is a capital expenditure. Whenever you lease an asset, you lease a machinery, equipment, and certain on which you just need to pay a monthly rent or monthly lease fees, that is an operating expenditure. So buying versus leasing is basically your capex versus opex. If you're wondering what's the importance of this thing in a project manager, as a project manager, hold on to your seats. We're going to jump into depth of it right now. Now let's say you need to purchase a big machinery to successfully complete your existing project in hand. For procuring that big machinery, obviously it's going to involve a huge outflow of cash. Might be the machinery cost around $1 million, another additional 10-20,000 for transportation, installation, and stuff like that. And there is another company who is financing the same machineries for a year-to-year basis based on a lease fee of say $20,000, $30,000 a month. Now, which is a better option for you as a project manager to ask your company to allocate to you? Is it buying a new machinery for you or is it leasing the new machinery for you? We'll understand this thing with the help of an example over here, which will help us understanding it in a better way. Now let's say we're going to do an analysis of capex versus opex. Okay, that is buying versus leasing. Okay, yeah. So here we're going to list out the line items. Here we say the company incurs an expense, a capex expense, and here we say the company incurs an opex expense. That is, they buy the machinery over here. What is the scenario if we buy it, and if we lease it, what is the scenario over here, right? So cost of the asset, it's $1 million, right? We'll continue with the same example which we had just used for the theory part. That will enable us for easy understanding. $1 million for the machinery. Sorry, that meant to 10 million. That's it, $1 million. Cost of the asset for an OPEX is going to be $0, right? Because you're not buying the machinery, you're just going to lease it out. Now, cost of transporting the asset is supposedly another $10,000. It's a heavy machinery, gonna get it from the factory to the site. Let's say in case of lease also, the lessor is not that much lenient with the money, so he asks you to bear the expense if you want the asset delivered to your premises, and you need to do that because it's a heavy machinery which is required for the project. Over here you also incur $10,000 of expense for getting the machine to premises. Annual lease at the rate of, let's say, $20,000 a month, dollars per month. So it's going to be $20,000 multiplied by 12. That's going to be $240,000. And let's say a security deposit refundable, which is refundable security deposit. It's supposed to be, let's say, around another $100,000. Okay, over here the sale value, okay, wait, we'll put the sale value of the machinery over here of the asset at the end of 3 years. Might be we charge a depreciation of somewhere around $150,000 a year. So that's going to be $450,000 for 3 years on a straight line basis. We're taking a 15% depreciation. So that leaves the asset with a residual value of, let's say that's going to be equal to $1,000,000 minus, it's going to be depreciation of $450,000. So that leaves the machine with a value of, at the end of useful life, of $550,000, which is going to be realized. So here we're going to understand this thing, that this is the outflow of the amounts. Okay, you have to incur these amounts to get the machine delivered to your premises. So looking at the scenario over here, if we take it for a first year of total annual cash outflow for first year, for first year we're going to have cost of the asset to be incurred if we buy the asset and cost of transporting the asset. We don't consider the sale value as of now because that's going to be realized at the end of the third year, and we're just considering the factors for the end of the first year. Okay, that's why we have ignored this figure for the time being. Now over here we do the same thing. We have to transport the asset to our premises. We're going to pay an annual lease of $240,000 and we have to pay a refundable security deposit of $100,000. Even though this is refundable to us at the end of the third year or fifth year, whenever you're going to complete using the asset, it's still an outflow of cash for the first year, so we're recording it as an outflow. So if you see the difference over here, that's huge, right? $1,000,000 and 10,000 versus $350,000 just to lease the asset. If you are working as a project manager and you have this dilemma whether to buy the machinery itself or to use the lease facility if it's available, this is the competition you need to refer to understand what amount of pressure will it put on your budget as a company, to understand which is the convenient way to use your resources the most efficiently without putting much more resource constraints on your own budget, and utilizing the machinery to the most efficient way, right? This is a simple computation on the reason of using a machinery by way of leasing rather than buying. Now let's see let's see what is the impact at the end of the third year. We supposingly we see what is the total outflow for 3 years. Okay, so here we're going to have the same outflow of cost of the asset plus cost of transporting the asset, and we're going to receive the value at the end of third year for $550,000, saying under the assumption that we're going to receive the entire value of the machinery. Okay, there's no reduction going to be there. Still we end up incurring an outflow of $460,000 versus over here, if we consider the cost of the asset for this one over here plus $720,000, that is $240,000 into 3. Just make me compute this as 3. Okay, so here we're going to compute $10,000 plus $720,000, and we're going to ignore the security deposit for the time being because we paid at the first year, we receive it back at the end of the third year, so that effect nullifies. So the total outflow which we incur is $730,000. So now you understand that your computations are changing up. Now if you look at the long-term scenario, as a project manager you need to take up the machinery on a capital basis, like you need to buy the machinery. That's going to be realizing you much more, that's going to reduce your outflow over a period of 3 years rather than the leasing of the machinery, right? So that is how you interpret the capex versus opex figures. Okay, buying versus leasing facility for a new asset. And with this we complete the most important analysis of buying versus leases, capital expenditure versus operating expenditure. There's no standard definition that you need to buy an asset or need to lease an asset, anything. It's entirely upon you to take a rational call based on the understanding till what point of time you're going to use that machinery, till what point of time you're going to sell that machinery, and what is the resale value and stuff like that. Okay, that was all with regard to buying versus leases. Now we begin with section C on performance management. In this section, we're not going to go through any of the computations, examples, and such stuff like that, because performance management of a project is entirely in the hands of a project manager ideally. But Based on this understanding of the various financial statements, the return on investment computations, capex versus opex, cash flow, you are sufficiently equipped to use those tools to enhance your project, to measure the performance of your project, and also take the corrective steps to increase its performance. I'm going to share a few tips with you on how you can and you should do recommended to do those steps to keep a track of your project's performance over a period of time, also taking necessary actions in as and how the project progresses. But that list is not exhaustive. It's just a few steps on how you can manage or you can enhance the performance of your project. So let us begin with this concept of performance management. Now, it's recommended to conduct the following activities on a recurring basis for effective performance management of the project. Okay, it is recommended you conduct these activities at least if for your project on a month by month, at least recurring on a month by month, preferable to do a weekly, but that will be too chaotic. So the ideal timeline will be a month on month performance based evaluation, right? Analyze the detailed P&L statement on a monthly basis. Now that you're aware of how to study the P&L statement on a detailed basis, request your finance department every month on month basis to send the P&L statement for related to your project, where you can understand what are the revenue, how is the revenue trend going on, is it increasing, is it decreasing, is it stagnant, is the cost of expenses or the cost of revenue becoming high, that is the cost of undertaking the activities to generate the revenue, is it increasing, is it decreasing, is it stagnant, and stuff like that, based on which you'll also be able to pinpoint if the additional or you can say the expenses which are not relevant to your project, are they increasing in volume or are they reducing or are they same across from the beginning of the project. And if the other expenses which are not relevant to your project, if they are increasing over the time, that's a red flag. You can point out to your managers, to your leaders, and say that this might impact your conclusion about my existing project, because the common expenses being allocated are increasing on my project day on day basis, right? So that is why it's important for you to analyze the detailed P&L statement and take corrective actions with regard to whatever red flags comes in. Can be increase in the cost, drop in revenues, increase in other expenses being allocated, and stuff like that. Keep a track of the ROI for your projects. Now, if you are a manager who has multiple projects going on, it's very important for you to keep a track of your return on investment on every project. That's simple enough. What costs are being incurred, expected to be incurred? What is the profit they expected to be increased, expected to be receivable from the incurrence of those expenses, and computing the ROI, return on investment, for every individual projects. Now, we had studied this entire concept of computation of ROI in the Excel sheet, if I hope you remember that. And we had understood how a small change in the cost can drastically change the decision of the whether to drop the project, continue the project, whether it can change the entire preferential order for the project. That's why it's important for you to have a clear understanding of your various projects ROI. So supposedly in the future, if the management tells you, hey, you got 5 projects in hand, you can only afford to finance 3 of the projects, you choose which 2 to drop and which 3 to continue. You should have a clear understanding of your functionalities, at which projects are performing up to the optimal level, not just in terms of dollar value. That will be highly misleading, and the ROI computation comes really handy at those point of time. Next is comparatively study the P&L and ROI of your projects to keep a track of how your project is performing. Not only just the dollar value or the net profit computation is essential, that's just a piece of the puzzle. You also need to supplement it with the ROI computation, because absolute dollar profits can be misleading sometimes, but ROI accompanied with the absolute dollar values gives you 100% correct result for most of the time. Okay, if you have an increase in profit but your return on investment is decreasing, that means the cost which you are incurring to increase the profit is much more high than the increase in the profit itself, which is offsetting, which is why the return on investment is going down for that particular project. If the dollar value of the project, if the net profit of the project are increasing along with the increase in return on investment, that's a super project to carry on. And those are the analysis which you can only derive when you have a thorough understanding of the P&L and an ROI, and you're tracking both of them simultaneously, starting both of them simultaneously for every of your existing projects. Understand the requirement of the capital asset and plan for its leasing accordingly. Now, based on the previous lecture itself, previous session, where we understood the entire capex versus opex scenario, buying versus leasing. If your project requires a substantial amount to be invested in a fixed asset, and you need to determine what period of time you want that asset to complete your project, and based on that, you make up the analysis. Is it better to buy the asset with the resources, or is it better to lease the asset? And accordingly, time is the biggest factor over there. As you had seen, if you recall previously, when we had completed the 1 year calculations, in that point of time, we thought it's better to lease the asset. When we extended the computation to 3 years, our decision went in the favor of buying the asset. So that's all tricky parts which are taken care by the you need to take care as a project manager to enhance the efficiency of your project, to make smart effective decisions. And lastly, keep a track of the expenses and eliminate the unnecessary expenses. This is important not only for the projects, for your personal life also, but we'll stick to the project management aspect because this is not a financial literacy course. So keeping a track of every expense which are incurred for your project and removing the unnecessary expenses which don't really need, which whose presence are more taking the project down rather than increasing, rather than providing any additional values. And again, I'll re-emphasize the fact that even small changes in the cost can cause a drastic change in your return on investment. If you have any doubt, see the entire slide on our ROI computation, how we worked on the Excel with the different numbers, with the different permutation combination. And just by changing a $20,000 of a cost in a project of $500,000, the project preferential order changed from number 3 to number 1. The percentage return on investment changed from 25 to 32, I believe so. That's right. These are the these are some of the strategic key points which you need to follow irrespective of the fact whether you're doing a financial project, non-financial project, any project. And it's important to understand these aspects of the project management, these aspects of the related to the financial components of project management. It makes you, these are the tools which will give you to manage a project to the greatest efficiency, as well as defend it when the times are high, when the times are going against you, when you are in a negative situation in front of a manager, right? So I hope you had a thorough understanding of the performance management tools, and now you're good to go in the financial world out on your own to show your project being managed very well. Well, I hope you got the point. That's it. Okay. I'll see you in the next session where we start with the project evaluation techniques. Now we begin with a section D, that is project evaluation. So first of all, what is a project evaluation? Let's understand that. Till now, we have seen performance management, cash flow, return on investment, concepts of financial statements, and stuff like that. But when we this all is tied up to the project, okay, which you are taking in hand. So the most important concept: how do you evaluate your project? How do you evaluate what's going on in the project? What point of time do you evaluate, and stuff like that. All that questions will be answered in this section that is based on entirely on project evaluation. Okay, so coming back to the point, what is a project evaluation? To put in a layman's term, project evaluation is a rigorous examination of your project, of the project, on the various metrics which are financial as well as non-financial, to evaluate whether it is feasible to accept the project, and if the project evaluation is done for an existing or an ongoing project, to evaluate whether it's feasible to continue the project or divert the resources to some other projects. Okay, evaluation can be done in terms of factors like technical performance of the project, schedule to complete the project, additional cost to be incurred to complete the project, better opportunity available to, rather than deploy the funds in the existing project to new projects, or just invest it in some good securities and generate a better return compared to the existing project. In the impact the project can have on the brand value of the company on its completion, or is it better to drop off because it is not performing up to that level where the company had expected it? What's the opportunity cost to complete the project, opportunity cost to take up the project, and stuff like that. So I hope you get the idea that project evaluation can be done in tons of financial as well as non-financial metrics. Okay, but we are going to restrict ourselves to the financial aspect of the project evaluation. Okay, because we are mainly concerned on how to use the financial management aspects to the for a better project management. Second question comes is that what is the need for project evaluation? We understood the fact that yes, project evaluation means a rigorous examination of the project in terms of financial, non-financial metrics, and so on. But next important point is what is the need for the project evaluation? Here we have two perspectives. One is from the organization perspective, what's the need for a project evaluation? One is from the project manager perspective, what's the need of the project evaluation? From the organization perspective, organizations are always facing a resource constraint and they cannot accept every project which they come across. Even though if the project gives a good return, a positive return compared to their expected factors, they still always have to make a decision, choose between one or the other. And that's where the project evaluation comes in. So return on investment, which we had just studied some couple of minutes sessions back is just one aspect of project evaluation. That is an important factor, but that's just one aspect. There are also different methods which organization deploys based on the situation and based on their requirements from the project to evaluate whether they should continue the project, or if it's a new project, to evaluate whether they should accept the project and carry on. From the project manager perspective, now the project managers, they are accountable for the success of the entire project. So before accepting a project, it is project manager's responsibility to make sure he knows all the important aspects of the project on which he is going to be evaluated, and he is ready to, or he can say he is ready with his analysis beforehand to explain to the management why he thinks the project might not be a good fit, what deviations need to be made compared to the current analysis part, and so on, just to make sure he is in a safe position and it's not coming under, he and his team do not come under undue pressures later stage of times. Okay, so those are the two aspects why a project evaluation is important. Now, third question comes in mind is that when is the project evaluation done? So project evaluation is a continuous ongoing activity. It's done prior to the commencement of the project. To accept the project, what there are various feasibility done, whether to accept the project or not to accept the project. Here the main question to be answered is whether we should start the project or drop the project before it's, or reject the project. That's the correct term. Next comes is for an ongoing stage. Now, when the project is ongoing, obviously it goes for some projects do extend beyond months, some go beyond years. So it is necessary to evaluate to keep a track of the progress on an ongoing basis to determine at what point of time they should drop the project, they should put a stop to the project and say, okay, whatever cost has been incurred till now is a sunk cost. We do not need to incur more project cost, more cost for this project. We have better opportunities online and let's focus on that aspect. The lastly is post completion. Once a project is completed, there still remains a part to evaluate. Did the project give the results as expected? Did the project meet its expected standards or not? Did the project no fulfill its test, which on the basis of which the company took the project? Did it enhance the brand value to that extent which was expected? Did it generate the profits to that numbers which the profit numbers were hit by the project, and so on? These questions are answered at the post completion, after the project is completed. Was the project manager efficient in his completion of the project? What could have been done better? Where did he had a slack? What was the reason for the increase in the cost? What were the reasons for the efficiency of the project, and so on? Now, note over here, the contention of the management might not be just to, take out flaws from the project manager. It can also be to find out what are the best practices applied by the project manager and apply them across all of the projects for the company. That can be a good resource or good value addition to the company for its other projects also. So these are the aspects with regard to project management, project evaluation. What's the need? What is project evaluation need for it? When is it done? And so on. I hope with this you have a thorough understanding of the theoretical part of project evaluation. In the next session, we're going to start with the actual uh, techniques of evaluation of the project. But before that, let's quickly go ahead and look at what are the different methods of project evaluation which you're going to study in this session. It's going to be net present value, where you compute the future value and present value of the money of the entire inflow and outflow of the cost in the project. Don't just bother for the timing with the names of the project techniques. It's just for giving you a heads up. We're going to cover each and every technique in a detailed lessons going forward, in a detailed session, along with an example for every of the concept, and examples will be done in an Excel sheet in front of you guys. So when you have an understanding of how the entire process is going from point A to B, from B to C, and you can practice on your own also. Next will be your internal rate of return, that is IRR. Third is the payback period of the project. This is the simplest one to calculate, trust me. Fourth is the discounted cash flow analysis. Fifth is the opportunity cost analysis. And lastly, we have earned value analysis. Now, because you have an entire list of the various projects going on, you might be concerned as a project manager, which method am I supposed to use? So the answer is there's no one size fit all. Yes, there's no one size fit all. Now, every project evaluation technique, it serves a different purpose, and therefore it is important to select the method according to the needs of by which you are starting the project, or you can say according to the needs of your organization. Okay, every project serves a different method, every project serves a different requirement for a project managers for the organization, and the project manager and the management of the company selects the method which provides them with the objective fulfillment which they are looking for. Let's say priority of the company is to recover the Cost invested on a priority basis rather than looking at the long-term profitability. In that case, you use the payback period rather than the income analysis part, you can say, or the IRR method. That's why it's important to know what is the company's requirement. Is it the fastest recovery of the cash? Is it generating a great return on the long-term basis, and so on? Need not worry. We'll go about with each and every method in a detailed session in the next sessions. Till then, I hope you had a good understanding of all the concepts till now. If you have any doubts, at least go back and refer to all the slides and thoroughly study the examples. Understanding the numerical financial concept is much more important than the theoretical part, right? Once you have a good understanding of the numerical part, you will be definitely empowered with all the tools for making sure you manage your project to the most efficient way. Till then, I'll see you in the next session. Have a great time.